Hey everyone, Bill Hodgin here, and welcome once again to the Hodgin Law PC International Tax Lunch. We do this noon Pacific time, last Friday of the month, almost every month, unless it collides with a holiday like Thanksgiving and Christmas, in which case we either move things around or we cancel entirely, depending. This month is all about, this is the fourth in the series about foreign trusts, and this is about accumulation distributions. And unlike last month where I talked about accumulation distributions, this month we're going to get nerdy and walk through Form 3520 and 4970 that will show you exactly how the accumulation distribution amount is computed, where it comes from. And once you've got an amount, you've got to figure out how it's taxed. And we'll walk you through Form 4970 to compute the accumulation distribution tax, and Form 3520 Part 3 Schedule C for how to calculate the interest charge on the accumulation distribution tax. So that's the game. So this is going to be heavy into the forms and heavy following the bouncing ball from one form to the next and one line to the next, and we'll see how it works. So there you go. We have wrapped up the little mini series on foreign trusts. If you are interested in more foreign trust topics, let me know. Shoot me an email. My email is on the last slide in this deck, and you got a PDF this morning. And if you're watching through CalCPA, thanks CalCPA, you can download a copy of the slides from your portal there. Table of contents, just so we have a place where we're going, and you can look at the PDF later and find what you need to find later. You see, I walked this through in 7 steps, all the way from getting the data either from the beneficiary or the trustee, all the way to the end until you figure out how you get the tax and the interest charge over onto Form 1040, so your U.S. beneficiary can pay Uncle Sam however much Uncle Sam wants. So let's start. Here's my little handy dandy chart. And what we're going to be talking about today is just the stuff with the pale yellow background. That's the accumulation distribution portion. But I've tried to give you a big picture sense of how it all works when a foreign trust makes a distribution to a U.S. beneficiary. The stuff in the yellow is the accumulation distribution portion and how it bounces from one form to the next and one task to the next. And the stuff outside is the current year distribution amounts, which are going to drop onto Schedule E or whatever wherever they're going to go. So the capital distribution, where does that go? In your pocket. So this is where we're going. You can see we start with step 1. You're going to get some data either from the trustee or the beneficiary. It's going to be on a foreign non-grantor trust beneficiary statement. We'll talk about what that is or not. You're going to get out of the sky. Yeah, I got some money. Step 2, you're going to look and figure out, well, how much is the distribution? And it's not just, well, they sent me a wire worth $100,000. There are other ways that the trust can be deemed to make a distribution to a beneficiary. We'll talk about that. Once you've figured that out, we're going to select as step 3, the calculation method. I have to look over to the side because I have the big monitor that you're seeing, and I have the little presentation, which is teeny tiny and unreadable from this distance on the laptop screen that I'm talking to you through. Anyway, so you're going to select the calculation distribution method, and there are 2 methods for figuring out how much of that distribution to the beneficiary is deemed to be a distribution from accumulated income. You can see step 4 spans 2 of these things, and the output of what you're going to do, either using the default method or the actual method, we'll talk about that, is a whole bunch of data. And the blue is your accumulation number, and you're going to get different numbers depending on which method you get. But once you have an accumulation distribution, you're going to go play on Form 4970 to calculate a tax. You're going to take that tax over to Form 3520 Part 3 Schedule C, and you're going to calculate an interest charge on top of that tax. Those 2 numbers are combined on Form 3520 Part 3 Schedule C, And that single number gets ported over to Schedule 2 of Form 1040, and you can take it from there. So that's the flow of it. And really the hard part is at step 4. The big, as there are lots of little pieces, that means lots of little works. So let's start with the data. Where does data come from? The tax accounting data, because someone comes to you and says, I want to do a tax return. How much money did you get last year? That's income. I don't know. Well, you need to know. And once you've figured it out, you need to know that number. You need to figure out what it is. Anyway, from a foreign trust, data it's either going to come from the beneficiary who tells you how life worked for him or her last year, or it's going to come from the trustee in some fashion or form, ideally in a thing called a foreign non-grantor trust beneficiary statement. You can see the reference to the proposed regs there, and you can see a reference to the notice 97-34 that gives you the details of what it is. And think of this as a kind of roll your own substitute for a Schedule K1 that you would issue bolted to a Form 1041 for a domestic trust. They don't have a special form like that for a foreign non-grantor trust because it's a foreign taxpayer, so why would the US government publish such a form? So you have to do a roll your own, and I'm going to give you the details of what is there. Anyway, ideally, data comes from a foreign non-grantor trust beneficiary statement. This is good, or it comes to you in any other way. The email, they told you something, or they delivered a foreign non-grantor trust beneficiary statement late. And there are all sorts of ways that you can get stuff. And the any other way has dire consequences for the beneficiary. It locks you out of a method of calculating the amount of the accumulation distribution that's probably beneficial, and it's going to lock you in to a method for calculating how much of this distribution received as an accumulation distribution. That's probably going to suck. So you really want to have a trustee who is on the ball and is going to issue a foreign non-grantor trust beneficiary statement to the beneficiary every year on time. And here in the little teeny tiny text, I'm not going to read it. You can go to notice 97-34. This is just an excerpt of it, and it gives you the bullet points that the government wants to see. Some of them are reasonably precise. Another one is, well, give the beneficiary whatever information the beneficiary needs to compute his U.S. tax liability, right? It's just sort of everything. But again, think of this like a substitute for Schedule K1. So you're going to get down to granular data if you are preparing the foreign non-grantor trust beneficiary statement for a trustee. You're going to get down to granular enough data so you can prepare the U.S. beneficiaries Form 1040. All right. So you got your data. Either you got it in an email, the trust wired me $100,000 last year and that's all I got, or you got a full-blown and beautiful and on time foreign non-grantor trust beneficiary statement. Now we're going to go on to, all right, you got a distribution. Now we're going to figure out how much the distribution is. And there are 3 different types of distributions. The first one is the normal kind of distribution, which is I got a wire for $100,000 from the trust. Easy, right? Relatively. But there are 2 kinds of other sort of deemed distributions that are not so easy necessarily. The first one is loans from the trust, and the second one is uncompensated use of trust-owned property. So loans from the trust or loans of marketable securities. Basically, you loan them and that's tantamount to a guarantee, right? Anyway, loans are toxic. Use of trust-owned property is toxic. So here's the rule for loans of cash or marketable securities. It's not such a big deal if you have a loan from the trust to your U.S. beneficiary that you're preparing the tax return for. What's hard here is that a loan from a trust to a U.S. person related to the beneficiary is treated as a distribution to the beneficiary. So you kind of have to get into the weeds a bit and find out, did the trust in the abstract make loans to U.S. people? And if so, did those loans, is that person, the borrower, quotes, related to the U.S. beneficiary? And related is the Section 267 rules that we all know and love. So it's no big deal. And there's also a clause in the proposed regulations that says when an indirect loan is treated as if it's a loan to the beneficiary. And that's kind of as broad and sweeping as you might fear it would be. So you have to look for indirect loans. So really, if you are doing a ground up work, maybe for the purpose of representing the trustee of this thing to prepare the foreign non-grantor trust beneficiary statement, you got to look in the abstract, were there any loans at all? And then you sort of trace them down and see if they trip over one of these tripwires here that creates a deemed distribution to a U.S. beneficiary. There is a type of loan that is not deemed to be a distribution ever. And this is called a qualified obligation. And I give you the site here to where to find it all. But the high points are, you got to have it in writing, has to have a maximum 5 years term. Interest rate has to be pegged to AFR, not too high and not too low. And it has to be in dollars. So if you do that, that's treated as a loan from the trust to the beneficiary. Of course, it has to be repaid, and it's not a distribution to the beneficiary. The other one that we see is the use of trust-owned property without paying any money. So a foreign non-grantor trust owns a house in the United States. The house, the trust has beneficiaries. One of the beneficiaries is a U.S. person. U.S. person gets to go use it. It happens. It happens to my clients. People will buy, the mythical condo in Vail, and the U.S. beneficiary kid will go there. Foreign trust will buy a property, close to the university where the kid's going to school, and the kid will live in the property instead of living in the dorm while going to university, stuff like that. So whenever a U.S. person, or again, a U.S. person related to the U.S. beneficiary, when that person uses the property without paying fair market value rental income in the case of a property, that's a deemed distribution to that beneficiary. And it extends even over to foreign related persons. So you have a situation where you have two siblings, one of which is a U.S. citizen, one of which is not, and the non-U.S. sibling uses the property. That person is deemed an agent of the U.S. beneficiary, and the U.S. beneficiary has a deemed distribution. There are exceptions in the proposed regs, but you have to prove to the satisfaction of the commissioner there's blah, 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 arm's length and all that sort of stuff. So the moral of the story to get out of this is, when you are preparing a tax return for a U.S. beneficiary of a foreign non-grantor trust, you have to poke and pry a little bit on these questions of, is there a loan that will somehow be tagged as a distribution to a U.S. beneficiary? Or is there use of trust-owned property without paying fair market value rent? And that, so you can see if there's a distribution there or not. And you will do as much or as little poking and prying as your circular 230 professional obligations feel like they're weighing on your shoulders heavily. But I would suggest you at least have something documented in the file that you asked around and see what's there. All right, let's just arbitrarily say we have identified all of the distributions, either cash money, y'all, or use of property, or a loan that's deemed to be a distribution. So we know what that is. And now we have to figure out, how much is it worth? And here are the quickie rules. I mean, you get money, you know what money's worth. But for the Section 643I distributions, this is the way that you value them. Loans of cash, use the OID rules to calculate what it is. For loans of marketable securities, it's going to be fair market value of the securities. For use of trust-owned property, it's fair market value minus payments actually made. And you have to make the payments in a reasonable amount of time. And I note there that there's a safe harbor in the proposed regs that says 60 days. So if you move into the house and you're using it, and you're a US beneficiary of a foreign trust and the trust owns that house, you got 60 days to start paying rent. Otherwise, it's going to be a deemed distribution. Right. There we go. So far we're at the place where we have identified that a distribution exists and we've figured out what the dollar value is of that distribution. Now let's start to bounce around in the forms, and we're going to take that information that we have, we're going to stick it onto Form 3520. And this is my little sample set of data that I'm going to be using for the rest of the presentation, where we have a trust that was created in 2020, $200,000 of cash put in it, and it just cranks $5,000 a year of distributable net income. So if you have that going on and it never distributes anything until 2024, and in 2024, it distributes $125,000 of cash to the US beneficiary. And you can just eyeball that. You can see, well, they gave 5,000 of the current year DNI, and they gave 20,000 of the undistributed net income from prior years. That's 25 grand. And they gave $100,000 of capital. So that's, you just eyeball it. You say, well, that's what the result should be. Now let's walk it through slowly and we'll see how it actually comes out. And there are two different, wildly different numbers for the tax liability, depending on whether we use one method or the other method for doing the calculations. So that's a little example. In our example, we just have a cash distribution. So that goes on line 24 of Form 3520 Part 3. We then have, do we have any loans or uncompensated use of trust property? These are the Section 643I distributions. Nah, 25 is empty. 26, do we have any loans that are qualified obligations? In other words, the loan was made from the trust and is deemed to be, would ordinarily be deemed to be a distribution to the US beneficiary, but it's not because it fits within that 5 years and enough interest and all that stuff. No, we didn't have any of those. And line 27 is your total. So we have 125,000 of a trust distribution from a foreign non-grantor trust to a US beneficiary. And now we have to figure out, what do we do with that 125,000? And to be precise, how much is the US beneficiary going to pay to Uncle Sam for the privilege of receiving that $125,000? And here we come to the fork in the road, sheep and the goats, whatever metaphor you want. There are two methods that we can use to calculate how much of that $125,000 is treated for calculating tax liability purposes as the distribution from accumulated income, from UNI, if you wanted to have it that way. One is called the actual calculation method, and that simply follow all of the trust income tax rules that you know and love for distributable net income, undistributed net income, and all that stuff. And you use those, and at the trust level, they calculate out how much is the undistributed net income, and then we'll figure out how much of the distribution came from undistributed net income. So this is just like normal stuff. And the default method is when you have insufficient data to do the actual calculation, like the trust's accounting records have gone to hell and you have just wild gaps and you can't calculate, back to the beginning of time. how much, what happened in the economic life of this trust. And the default calculation method is said, well, if you cannot use the actual calculation method, here's a little simple math puzzle that you can use, and we'll just apply it, and it'll tell you of a distribution, how much of that distribution is an accumulation distribution. So which method can you use, or can you choose to use? You can use the actual calculation method. Remember, this means that you're getting God tier foreign non-grantor trust beneficiary statement from the trustee on time if all of these things are true. Number one, you're filing a timely tax return. So if you're filing a late tax return, you're out of luck. You're stuck into the default calculation method. Number two, you received a foreign non-grantor trust beneficiary statement before you filed your income tax return. And you're going to have to bolt this thing to the back end of your tax return. So it's either yes, you got it, or no, you didn't. And there's no middle ground on that. So you received a timely foreign non-grantor trust beneficiary statement, and timely means you got it before your filing deadline, including extensions. So if you didn't, again, default calculation method. And then one of the third things is true, which is either you've never used the default calculation method in the past, because the default calculation method is kind of like the Roach Motel. Once you go in, you never get out. It's kind of like a PFIC, right? Once a PFIC, always a PFIC, unless you do a purging election. And same thing with the methods for calculating the amount of distribution, accumulation distribution, which is once you're locked into the default calculation method, you're locked in for the rest of your life until you die or the trust terminates and makes its terminating distribution to you, in which case you can revert in that final year back to the actual calculation method. So this is fairly restricted, and you can see the way gravity works in the tax code here. It works in favor of pushing you towards the default calculation method. And you have to invest a lot of energy to fight against that entropy in order to stay in and use the actual calculation method. So here's out of the proposed regs. You can use the actual calculation method or the default method. You could always choose into it the default calculation method if you want to, unless the foreign non-grantor trust beneficiary statement is BS, or you've previously used the default calculation method. So this is in a nutshell, this is where it is. And you can see it on Schedule 3520, Part 3, line 30, where you're making a checkbox, yes, no, or does not apply. Did I get a foreign non-grantor trust beneficiary statement? And you can see there it says, if yes, you choose either Schedule A or Schedule B below. Schedule A is where you calculate accumulation distribution based on the default method. Schedule B is where you calculate the accumulation distribution based on the actual method. So this is where you declare to the government, this is the way I'm going to go. And once you're locked into the default method, you're locked in for life. Now, so we've got the calculation method. We've selected which one we want to do. We know how much distribution we got. And now we're going to figure out, of that $125,000 in my example, where I'm going to run that $125,000 through both of these different methods and show you what the outcome is. But first, I want to show you why the default calculation method is going to be almost always worse than the actual calculation method. And look at these two things. So first, on the current income. Current income under the actual calculation method comes out and is taxed to the U.S. beneficiary, and it keeps its character, tax-exempt income, qualified dividends, whatnot, just like a Schedule K1, right? With the default method, there is no such thing. So all of these things, long-term capital gains, are converted to having the character of ordinary income taxed at ordinary income tax rates. So you're losing the capability of having a lower marginal tax rate on an income item if you use the default calculation method. Accumulated income is taxed the same way for both of these types, both calculation methods. And you'll see when we get to Form 4970 that the two outcomes look very similar, except the top number, 125,000 for the default calculation method, and spoiler alert, 20,000 for the actual calculation method. And then you'll see the consequences is just math after that to why, wow, the calculation method, the actual calculation method yields a lower tax liability. The third one, which is just awful, is capital. So a distribution of capital from a foreign non-grantor trust using the actual calculation method is just a tax-free distribution of capital to the beneficiary. For the default method, however, it's distribution and it's going to be allocated either as ordinary income or distribution from accumulated income, depending on how the formula works. So we have converted we've done some reverse alchemy here. We have converted some gold tax-free capital into lead, ordinary income at best, and accumulation distribution income at worst. So this is why invariably I find that the default calculation method is just nasty. And let's just define nasty and see what it looks like, as we'll follow the math through Form 3520 and Form 4970, and we'll show you what the results are. So back to my little method and my little garish colors and whatnot that shows you this is where the data will come from the accounting data that you have, and will drop into Form 3520. And first, we're going to look at Schedule A, which is default calculation method. And you can see I'm going to take on line 31, spoiler alert, $125,000 distribution goes there. Line 32, this is a calculation of how many years the trust has been in existence in order to calculate a number which will later be used for the interest charge. And line 33 is the 3 years of prior history for distributions from this trust to the beneficiary. And with those three pieces of information, you can now calculate of the 125,000, how much is going to be accumulation distribution and how much is going to be ordinary income. And this is what it looks like. It's not a big thing. You start with line 31, $125,000. There's your distribution. And then you go down to line 2, the number of years that the trust has been a foreign trust, including the current tax year. So 5, because 20, 21, 22, 23, 24, 5. I do math on my fingers. And then line 33, the total distributions in the prior 3 years, 0. Okay, well, lines 34, 35 are math. And line 36 is, the amount, no, pardon me, line 37 is the amount that's treated as the accumulation distribution. So what you see here is we're using a weighted average over the prior 3 years, and the input for that weighted average is the amount of distributions made over the prior years. And if the current year distribution is higher than that weighted average, then everything in excess of that weighted average is going to be accumulation distribution. Everything below it, that weighted average, is going to be treated as ordinary income. So those are the only two outcomes. And so it's really just this threshold that you have to calculate based on the prior 3 years distribution history. And that's all you got. And in our case, I made an extreme example that this is the first distribution that's ever been made by the trust. So all of it's going to be accumulation distribution. Now let's look at the contrast for the actual calculation method. And again, this means that the trustee delivered an on-time foreign non-grantor trust beneficiary statement. And we have here where the data comes from again. So 125,000 is going to go to the distribution. Now, because we're using the actual method, we want to actually know what the undistributed net income of the trust is. And because our trustee is highly organized and efficient, the records are good, and we have $5,000 undistributed net income in each of the prior 4 years. And that's the purple or pinkish purplish, whatever it is. And the aqua colored is the actual calculation method of what this distribution contained as far as the trustee is giving you. And you rely on whatever the trustee is giving you in this statement. So we have $5,000 of interest income that's allocated to current income. We've got line 41A, the 20,000 of undistributed net income, which is accumulation distribution, and line 43 is the capital. And this is what it looks like. So from line 39 through 45, you can see where the numbers go. Line 39 has the distribution amount, 125,000, just like the default method. Now, line 40A shows the ordinary income for the current year, $5,000. Line 41A shows the accumulation distribution, 20,000. And those three together, and then line 43 shows the capital distribution of $100,000. So that shows that's your equivalent of the roll your own schedule K1 if you want to look at it that way. Now the numbers at the bottom, line 44, 45, 46. Well, let's ignore 44 because it doesn't apply, because that would assume some other facts that I didn't make up in my example. But lines 45 and 46, this is used for the calculation of the interest charge on the distribution. So the trust accumulated income over the years instead of distributing it currently. And we want to figure out how long that accumulation carried on. So we could go back, and in the interest of ideological purity, we could say, well, there was $5,000 accumulated and not distributed in 2020. So let's calculate the interest from 2020 to the current day. And then there's another 5,000 accumulated in 2021 and 2022 and 2023, and we do individual interest calculations for each of those. Well, that's a big pain in the neck. And so what the government does instead is they have this weighted average methodology, and they have a little, this is how you do it. You put the undistributed net income each year, I've got that under the column UNI, and you give it a weight factor. So we're preparing a 2024 tax return. The undistributed net income from last year, 2023, has a weight factor of 1. It's been held back 1 year. The 2022 income was held back 2 years, and 2021 was held back 3 years, and 2020 was 4. So you have that weight factor, and you do simple math. Undistributed net income for that year times the weight factor gives your weighted UNI, and that you use that number. And you can see now where I got the source of line 46 or line 45 and 46 just from those two numbers, the actual UNI divided by the weighted UNI, and that gives, the aggregate weighted UNI, the 50 grand divided by the 20 grand, and that gives you line 47, which is the weighted time delay. If you want, interest has to be $ times interest rate times time equals your interest charge. And this is the time element that you're going to use in that little mathematical equation. And I'll show you where that goes in Schedule C in just a second. So we end up with, here's the comparison. We have something obviously not fun going on. The accumulation distribution for the default calculation method is 125,000. And the actual calculation method has accumulation distribution of 20,000 and capital of 100 and ordinary income of 5. And so even eyeballing this and knowing almost nothing else, you know things are going to suck bad for the calculation of tax on the default calculation method. So now we're going to go on, now that we have the calculation of how much is the accumulation distribution out of that 125,000. It's either 125 for the default method or 20 for the actual calculation method. We're going to calculate tax. And this is where it gets a little bit fussy. There are two taxes, one of which is the actual tax on the accumulation distribution, and the other one is the interest charge that is defined in the code as a tax, so they can assess it immediately. And those two together make the accumulation distribution tax. So the two parts make into the whole. We'll do first the Form 4970, which is calculating the tax on the accumulation distribution. We'll take that output. We'll go back to Form 3520, Part 3, Schedule C, use that output for how much the tax is to compute the interest charge. So let's do the default calculation method. So on Form 4970, there's Part 1 and Part 2. It's a one-page form. It's one of these iceberg pages where there's just one page. How hard can it be? Well, there's a lot of on the side kind of work that you have to do to get there to that one page. So let's start off. So line 1 is the amount of the accumulation distribution using the default method, 125,000. Subtracting line 2, let's not worry about what it is. It doesn't apply under our facts. Line 3 is the subtotal. Line 4, again, doesn't apply under our facts. Line 5, again, is the subtotal. Line 6, again, doesn't apply under our facts. So line 7 is the subtotal. And now we come to line 8, which is where we're starting to get the number of years. Because what we're going to see when we get to Part 2 is instead of ideological purity, and we're saying, well, the trust had accumulated income in 1971 of $4,000, and in 1972 of $12,000, and in 1973 of this and that. And we're not going to go do that. Instead, the government is just going to give us a handy-dandy averaging methodology that we just looked at the prior 5 years, do some quick math, and we calculate something that's close enough for science, in their opinion, to be the actual calculation of the accumulation tax. So in this case, we have a trust that's been in existence for 5 years, and the instructions say, how long has it been going on, not counting this year? So there's 4. That's line 8. Line 9 and 10, this is a method where it adjusts this number of years that you're going to throw back, the throwback period, depending on the amount of the distribution. And if the distribution is below that number on line 10, different rules apply. But I've set up the instructions so we don't have to go down those kind of rabbit trails and get into weird stuff that matters once every 7 years in your practice. And so what we end up doing is on line 11, we do another calculation for the accumulation period, which might have been shortened if the numbers on line 9 and 10 were different, but they aren't. So it's going to be, again, we're using a 4-year time period for the purpose of this Form 4970 calculation. And line 12, is line 7 divided by line 11, 31,250, and that is the deemed accumulation distribution per year that we're going to be working with, and we're going to be calculating the tax. Then finally, line 13 is where we bring the beneficiary in for the first time, and the averaging technique is saying, look at the beneficiary's previous 5 years of income tax returns and pull the taxable income. Why do they do this? Well, imagine we have a trust that was set up in 1965, and so the thing's been going on forever, and we have a 20-year-old beneficiary, and we're using ideological purity to throw back income to a tax year of the beneficiary before the beneficiary is born. And that and a number of other practical complications say why we're going to use this. So you find the beneficiary's prior 5 years income tax returns and you pull the taxable income off. And you can see I just made some arbitrary guesses for numbers just to make the example simple for what they are. We're going to throw out the high year and we're going to throw out the low year. So 2023 is the high year, 2019 is the low year. So we're going to keep 2020, 2021, and 2022 as the years that we use to calculate the average. And with that, we will move down to part 2 of Form 4970. And you'll see I repeated on line 14 the taxable income numbers from line 13, throwing out the high and the low. And line 15 has the accumulation distribution on it, 31,250 for each year. And what you do is you're looking for the difference between what the taxpayer actually paid in that year in income tax and what the taxpayer would have paid if that taxpayer had received $31,250 of ordinary income distribution from the trust in that year. And the difference between those tax costs is going to be taken down, and eventually we're going to use that number to be the accumulation tax. So you can see line 17 and line 18, I've done these calculations. I just use the tax tables to do these numbers for the 3 years. So you use the correct tax table for the relevant year. And then you see on line 19, that's the additional tax that the beneficiary would have paid if the trust had distributed $31,250 to the beneficiary in that year. Tax credit adjustment, we don't care. 21, math, 22, AMT, we don't care. Come line 23, subtotals. Line 24, we take all of line 23, add it together. Then line 25, we divide the added together by 3, and then we multiply by the number of years. Remember 4 above. So that's the entire period of the trust's existence as the throwback period. And we have a total tax of $23,188, which is the additional tax that this averaging method says would have been paid by the beneficiary if the trustee had made current distributions instead of accumulating income for a while. So 23,188 is your number. Now let's do the same thing a little bit quicker with the actual calculation method. Same thing, the only thing different here is that we're starting off on line 1 with $20,000 instead of $125,000, because you remember the foreign non-grantor trust beneficiary statement, upon which we can rely unless we know it's BS, said that the accumulation amount of that distribution is $20,000. We go down to line 8. Again, the trust has been in existence for 4 years and it's been accumulating all that time. So line 8 and line 11 are the same as before. So we're not going to have any problem with the time period over which the trust has existed, which we're going to use as the multiplication factor down below. And same assumptions for the beneficiary's tax years, 2023 backwards to 2019. And here's what the numbers look like now. Instead, same methodology, right? You pretend that the beneficiary received an extra $5,000 in ordinary income in that year. And how would that be taxed? And, because for instance, in 2020, they had filed an income tax return with $20,000 of taxable income. Now we have a hypothetical tax return of $25,000. What would be the extra tax that would be paid? In my case, line 19, $600. Do the math across the board, and thus you see your differential. We go down to line 23, which is the subtotal for the 3 years, which adds up on line 24 to $2,125. We divide by 3 because we want to get an average, 708. is the average additional income tax that would have been paid over those 3 years. We multiply by the number of years in this throwback period for the trust, and which is 4, and we end up with $2,832 of additional tax that would have been paid if the trustee distributed currently instead of accumulating to distribute later. All right, so we got the first half of the equation done, and now we're going to move on to the second half, which is the interest charge. And so this is just the government wanting a piece of that time value of money sweet pie. And so they're going to impose an interest charge on that tax that you paid in 2024 instead of 2021, 2022, 2023, and 2024. They want some interest on top of that to make everything even. So let's go now for the default calculation method. Let's look at Schedule C on Form 3520 Part 3, which is where all the fun happens. Line 48, we start again with the amount of the distribution, $125,000. This is the accumulation distribution. You'll see the different number on the next example I give you. We take the number of what was the actual tax liability from Form 4970, and we put that on line 49. Next, we're going down to the accumulation period. And remember, we did some math, and we did the math on line 37. Oh, there it is, line 38 for Schedule A, or line 47 for Schedule B. And that way, this is the accumulation method. And remember when I did the math on the accumulation, the actual calculation method, we took the $50,000 of weighted aggregate undistributed net income divided by 20,000 of actual undistributed net income. We got that 2.5 factor. And for the default method, we took the total year of the years that the trust has been in existence, including the current year, and divided by 2. And that's how we got the 2.5 in both cases. Line 51, now your interest rate. What's the interest rate? Well, the IRS has some handy-dandy little tables, and I'll show that to you on the next slide, where you take that number on line 50, your 2.5 accumulation period number, and you find it in the table, and it'll give you an interest factor that you use to calculate the interest charge. And in my case here, $4,503 is the interest charge. And I'm going to take line 49 and line 52, add them together, and line 53, hey presto, we are done. That is the tax liability for the U.S. beneficiary who is receiving $125,000 distribution from a foreign non-grantor trust, as computed with the default calculation method. Here's the little interest factor thing. The URL irs.gov/combined interest rate. That URL is also in the instructions for Form 3520, so you don't have to keep my slides around forever, but so it's there. And you can see I've highlighted the factor that I used here, 2.5, for the calculations that I'm doing in this example here. Now let's compare the interest charge for the actual calculation method. Again, we go back to Schedule C, and again, we start with the accumulation distribution amount, 20,000. And on 48, and line 49 has the tax liability on that 20,000 from Form 4970. Line 50, again, is the accumulation period. That came from our division of the weighted UNI aggregate divided by aggregate UNI, 2.5. And line 51 is the same interest factor from the same forms that the same table that I just showed you a couple slides ago. The math tells us interest charge on that $2,832 is $550. We add line 49 and line 52, and hey presto, congratulations. The trustee did the trustee's work by preparing the foreign non-grantor trust beneficiary statement, and the beneficiary's total tax on the accumulation distribution is $3,382. So let's compare the two and read them and weep, all right? So look at the total tax liability for the default calculation method, $27,691, and the total tax liability for the actual calculation method, $3,382. Well, I know what I'd rather have, but let's look at it a little bit closer. The first one is the ordinary income. Now, I'm assuming here that the beneficiary has no other taxable income. Therefore, this $5,000 distribution from the trust that's calculated to be ordinary income, it's below the standard deduction amount of what, 14,600 or something, whatever it is. So there's no tax on that $5,000. Yay. And that's for the actual method, whereas for the default method, that $5,000 is rolled into the accumulation distribution. And then let's look at capital. The capital comes out of a trust to the beneficiary, $100,000, tax-free under the actual calculation method, but capital is rolled into the accumulation distribution under the default calculation method. And that explains why the numbers are so wildly different. So this is why I said way back in the beginning, when we were talking about what is this thing called a foreign non-grantor trust beneficiary statement, why it's so important to have a trustee who's on it and who has good records going back to the beginning of time, and the trust accounting data will withstand scrutiny by a skeptical IRS revenue agent if this return gets audited. So this is the outcome of the two methods to this $125,000 distribution. Finally, let's just take it all the way, almost all the way home. You take that number from the bottom of Schedule C, line 53, and it goes to Schedule 2 of Form 1040 on line 17L, and then drops down to the subtotal at the bottom of the page. And then from the bottom of the page on Schedule 2, it ports over to Form 1040. And I forget the line, maybe it's line 23, but you can take it from here. So that's the complete arc of this fabulosity of accumulation distribution and how it works on a tax return, and as much as I can tell you how it works. A final bit of information for you. What about net investment income tax return, Obamacare? Net investment income tax does not apply to accumulation distributions. So that's good news. As near as I can tell, it's because the government hasn't figured out how to just work through the complexity of making it all fit. But there you go. You have the reference to the preamble of the final regulations under the net investment income tax rule, and says we ain't got none yet. The net investment income tax will apply to current income distributions, but in my example, that was not a problem. We had no current income, or in the case of the actual method, the income was so low it wasn't even taxable. So let's wrap it up and let's look at it. So this, in my mind, is really, it's a finicky thing, but once you've got it, the whole process is mechanical. The numbers flow through. If you're relying on the trustee to issue the foreign non-grantor trust beneficiary statement, the numbers just flow through from one form to the other and eventually to Form 1040, and you got your tax. If you're using the default method, you just work straight from the actual distribution amount that you received, do the math, and from then everything cascades through Form 3520 and Form 4970, and you have your numbers. The best way you can minimize costs, tax costs specifically, is for the trustee to have really good accounting records. And this is where professional trustees earn their salt. Not all foreign trustees are going to be up to date on the niceties of the Internal Revenue Code. So you need to talk to them because they simply may not keep the data necessary to do these tax calculations because it's unimportant in their jurisdiction, or they're used to dealing with people who are not U.S. beneficiaries. But to the maximum extent you can, you work on the trustee to get the foreign non-grantor trust beneficiary statement issued timely every year with the correct information so your beneficiary can prepare a tax return using the actual calculation method. The second best way to do this is by choosing the calculation method. And again, the beneficiary ultimately controls this choice, but unfortunately, the beneficiary's choice may be limited if the trustee never issues a timely foreign non-grantor trust beneficiary statement, because once the beneficiary has filed a tax return using the default method, it's game over until the end of the trust. So that's no fun at all. So even though I say the beneficiary has some control over that, not really. You're sort of stuck with whatever the trustee does. And that's about it. I mean, what you can see here is if you compare this to your experience with a normal domestic trust, this throwback rule stuff is really punitive, especially the recharacterization of income items, like from long-term capital gain to ordinary income or to accumulated income, or indeed recomputation of capital to taxable income. And so all else equal, if you are going to have a U.S. beneficiary of a trust for the long haul, and you expect that U.S. beneficiary to remain a U.S. person for life, you might want to think about getting out of the foreign trust and into a domestic trust for the purposes of keeping that U.S. beneficiary's tax costs low and the brain damage of preparing Form 3520, Form 4970 as lower too. So the accounting costs are lower too. Anyway, there we are. We're all done with this show. Thanks so much for being here. I know this is tax season. Next month is April 25 and 2025, and that is going to be something new, which is going to be Form 8858. This is for foreign disregarded entities. When you file it, what to report. So this is when you have an entity, a foreign entity, and you've made a check the box election for it, or you have one of these mythical beasts called a qualified business unit, and you have to file a Form 8858 for it. How does it work? See you then next month. If you're not on the mailing list already, go to hodgen.com and sign up and get newsletter and updates on these presentations.